Over the last 10 years, 85% of actively managed mutual funds failed to beat a simple index ETF. Not some years, most years, every year. And yet millions of people are still paying 2 to 3 times more in fees to get worse returns. Today I am going to show you exactly why and which one you should actually be using for your money. Stay until the end, because the answer changes depending on one factor most people never consider. Round 1. Fees and costs. This is where the gap is most visible and most damaging to your returns. The average expense ratio for an actively managed mutual fund is 0.73% per year. The average expense ratio for an index ETF is 0.44% per year. Some popular ETFs like Vanguard's VOO charge as little as 0.03%. That sounds like a small difference. It is not. On a $50,000 investment over 30 years, the fee difference between a 0.73% mutual fund and a 0.03% ETF amounts to over $40,000 in lost returns, even before accounting for performance differences. What this means for you, every dollar you pay in fees is a dollar that is not compounding. ETFs win this round decisively, and it is not close. Round 2. Tax efficiency. This is the round most people never think about, and it could be costing you thousands every year in unnecessary taxes. Mutual funds are required to distribute capital gains to all shareholders at the end of each year, even if you personally did not sell anything. This means you can owe taxes on gains you never actually received as cash. In 2024, some actively managed mutual funds distributed capital gains of 8 to 12%, meaning investors owed tax on a significant chunk of their portfolio value regardless of their own actions. ETFs are structured differently because of how they handle share creation and redemption through a process called in-kind transactions. They rarely distribute capital gains. Most ETF investors only pay capital gains tax when they personally choose to sell. What this means for you, if your investments are in a taxable account, not a retirement account, ETFs are significantly more tax efficient. This difference alone can amount to hundreds or thousands of dollars per year depending on your portfolio size. Round 3. Performance. Here is the number that should end the debate, but somehow does not. Over the last 15 years, 88% of large-cap, actively managed mutual funds underperformed the S&P 500 index. Not one year, not in a down market. Consistently, year after year, across 15 years. The reason is straightforward. Active fund managers charge higher fees to try to beat the market, but after fees, the majority of them do not. And the ones that do outperform in any given year are largely different from the ones that outperform the following year, making it nearly impossible to predict which managers will win going forward. Index ETFs do not try to beat the market, they simply match it. And after fees, matching the market beats most active managers. What this means for you, unless you have a specific reason to believe your mutual fund manager will be in the rare 12% that outperforms consistently, which is almost impossible to predict in advance, a low-cost index ETF will statistically outperform your actively managed mutual fund over the long term. Round 4. Flexibility and control. This is where mutual funds have some genuine advantages worth acknowledging. ETFs trade on a stock exchange throughout the day, just like individual stocks. You can buy or sell at any moment during market hours at the current market price. This gives you complete flexibility and real-time pricing. Mutual funds price once per day at their net asset value, calculated after markets close. You place your order and receive whatever price is set at end of day regardless of when you submitted it. For long-term investors, this makes no practical difference. But for anyone who wants control over their entry and exit price, ETFs are clearly better. However, mutual funds have one practical advantage. Many employer-sponsored retirement plans and 401k programs only offer mutual funds, not ETFs. If your only investment vehicle is a 401k through your employer, you may have no choice but to use mutual funds. What this means for you, in a taxable brokerage account, ETFs. In a 401k with limited options, Use the lowest cost index mutual fund available, typically a target date fund or S&P 500 index fund. Round 5. Minimum investment. This one matters more than people realize when you are starting out. Many actively managed mutual funds require minimum investments of $1,000 to $5,000 to get started. Some institutional funds require $50,000 or more. ETFs have no minimum investment beyond the price of a single share. With fractional shares now available on most major platforms, you can invest as little as $1 in most ETFs. What this means for you: if you are starting with a small amount, ETFs give you access to a diversified portfolio from day one with no minimums. Mutual funds can lock out newer investors with limited capital. Final scorecard fees: ETFs win. Tax efficiency: ETFs win. Long-term performance: ETFs win. Flexibility and control: ETFs win. Minimum investment: ETFs win. Availability and employer plans: mutual funds may be your only option. The verdict: for most individual investors with a taxable brokerage account, a low-cost index ETF like VOO, VTI, or SPY is the superior choice in almost every measurable category. The only time a mutual fund makes sense is when it is your only option inside an employer retirement plan, in which case always choose the lowest cost index fund available. Outro: the single most important number to check in any fund, ETF, or mutual fund is the expense ratio. Find it, minimize it, let compounding do the rest. Which are you currently using, ETFs or mutual funds? Drop it in the comments. I want to know what most of my audience is actually invested in.